spend a moment on the markets right now. We are seeing sort of a drift. One trader that I follow says it looks like we are coiling here for perhaps a big move ahead of inflation. And under the hood of this, we've been talking about it for a while, is sort of chatter about an internal rotation in the market, perhaps away from some of the big tech names to other parts of the market. Certainly, it's something that Bank of America thinks is underway. Let's bring in Ohsung Kwon. He's the Canada and U.S. equity strategist at Bank of America. Ohsung, thanks so much for being with us. It's all about leadership. Where is leadership going to come from as we get towards the end of 2023? How are you guys thinking about it?
Sure. Thanks for having me today, and great to be here. So we think that leadership is likely going to change in the second half of the year as we head into year end. We think value, cyclicals, high beta, and high risk stocks are likely going to outperform. And the reason why I say that is if you look at our U.S. regime indicator, it recently flipped to the recovery phase after being in downturn in the first half of the year. And if you look at some of the factors that have historically outperformed during this recovery phase, it's really value, cyclicals, high beta, high risk, high dividend yield, and low quality stocks. So those factors that have underperformed in the first half of the year, those are likely going to be winners in this recovery phase. And if you look at the factors that have historically underperformed during the recovery phase, it's really growth stocks, mega caps, high quality stocks. So those that outperform massively in the first half of the year, those are typically the laggards of this recovery phase. And we think we're going to see that big rotation going forward.
Can I ask for a quick explainer on what recovery phase means? Because in many ways, we haven't even, what are we recovering from? We haven't even seen the slowdown yet.
Yeah, so our view is that, the macro cycle has troughed, at least on a year-over-year basis. It's stopped deteriorating, and we could potentially see more upside in earnings and the macro cycle overall. And in fact, we think that Q2 was the trough in terms of earnings, at least for the S&P 500 companies, and we're going to see better results going forward in the second half of the year.
So value does better than growth, risk does better than quality, small caps do better than large in the recovery phase. Within that, I want to talk about dividend yields because the highest yielding stocks have not done well as there is an alternative now in the bond market. Does that also flip?
Yeah, so at this point in the cycle, what we typically see is high dividend yielding stocks typically become more value stocks, more beaten down stocks because the share prices have come down so much. So these are the value stocks, more cyclical oriented stocks that typically do well in recovery. And in fact, we actually just raised our view on real estate to overweight from market weight. And our view is that real estate is a real asset, but also a bond proxy. So if you want to own bonds, and there are a lot of people who want to own bonds these days, especially with rates already moving higher these days, why not own real estate? Why not own real assets that move like bonds, but you also get the inflation exposure and GDP exposure as well, especially if you're headed to a recovery.
Okay, that's interesting because real estate, especially commercial real estate exposure, office real estate exposure has become a bad word. Are you sort of just liking the sector? Do you still recommend you do some cherry picking there and stay away from office? How should we think about that?
Yeah, so we do think that you should be more selective, and maybe you still want to avoid commercial real estate sectors. But if you look at the S&P 500 real estate sector, office is only about 3% of the sector, so it's not a significant weighting in that sector. And other areas are residential, industrials, data centers, towers. So those are areas that could potentially still benefit from this macro recovery, but also potentially, is bond-like, and people who want to own bonds but still be protected from inflation. I think real estate is a great way to play that.
So you say bond proxies in the stock market that have been beaten up. I also hear utilities, but that's not a sector that you think could benefit in this cycle.
So yeah, let me clarify that. So we don't like bonds. We actually prefer stocks over bonds. But if you want to own bonds as a hedge, then we think real estate is a great way to play. Defenses, as I mentioned earlier, during the recovery phase, have historically almost consistently underperformed. And if you look at utilities performance, what's interesting is that it never outperformed during the recovery phase. The hit rate was 0. So utilities is one of the sectors that you might want to avoid.
And on the flip side, financials hit rate on the long side is 100%.
Yeah, financials I think is still a good way to play this recovery phase. It's beaten down. Dividends are healthy, and there are still a lot of concerns around financials, especially the banks. But if you look at S&P 500, the bank index, the regional exposure is minimal, and it's really the big banks who actually could benefit from the banking crisis that we saw, regional banking crisis that we saw in March through gaining market share. And it really feels like capital market activity is coming back. That's what all the banks have been saying. So I think there could be more upside in banks in the second half of the year.
Let's put the TSX in this conversation. When I spoke to you in the summer, you thought there's a chance the TSX could outperform the S&P 500 as value became the cool kid in town. Over the last 3 months, the TSX is still struggling versus the S&P 500. Are you still optimistic that the TSX can outperform?
Yeah, I still think that the TSX can outperform, especially with this confirmation that we saw in our U.S. regime indicator that we are in a recovery. And if this broadens out to not just the U.S., but more into Canada and globally, then I think the TSX having that cyclical exposure and value exposure, I think that index overall can outperform the S&P 500. And I think we also have to think about the secular forces that we are seeing. We think we are in this higher for longer inflation and rate regime, which is going to benefit the TSX more than the S&P 500. Also, the other thing that caught my eye recently was that we're really starting to see real evidence of reshoring. The reshoring has been one of my thesis of my bull case for the TSX or the S&P 500. And if you look at U.S. imports from China, it's now less than U.S. imports from Mexico or Canada. So we're starting to see, and that's for the first time since the financial crisis. So we're really starting to see evidence of reshoring happening. And I don't think reshoring is just a U.S. story. I think it's the North America story. So U.S., Canada, and Mexico all benefiting from reshoring. And I think that's one of the bull case for Canada that have not been priced into stocks yet.
And you see that as a structural trend, not a cyclical one?
Yeah, I think it's a structural, more secular regime shift that we're seeing. Obviously, with a lot of political tensions between the U.S. and China, post-COVID, companies realizing that, they have to rework their supply chain issues. And I think, I mentioned that it's a North America story. And, I think it's a very interesting story right now is that, we have a very strong consumer base in the U.S. We have commodities that we need in Canada, and we have cheap labor force in Mexico. And I think it's really those three countries integrating themselves and enabling this reshoring efforts together.